Welcome back. You're watching Stock Watch. I'm Zinati Guma, and joining me to unpack your stock-related questions tonight are Alex Duys from Umthombo Wealth and Graeme Körner from Körner Perspective. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Of course, it's been quite volatile, even though we have seen a rebound on the JSE today. But of course, a lot of these moves never last very long, as we've seen so far this year. Graeme, has there anything stood out for you in terms of trading, what you've seen in trading so far this year, and particularly on the JSE?
Well, I think it's just been incredibly volatile. I think year to date, we're down about 6%. And on a one-year view down, I think I'm talking now on the top 40.
Yeah.
I think we're down about 9%. Yeah, a lot of that has been attributable to volatility in a couple of the big caps, obviously. But I think what we're seeing is, still very little appetite for small and mid caps where we believe there's a lot of value. But what we're also starting to see is a little bit more stability in those, considerably less volatility, say, in SA Inc. stocks than maybe what you're seeing in the likes of Naspers and Anglos and Richemont. So, but it's been a very, very wild start to the year. Yeah, and I think Alex and I would agree. We've been denied decent years in the JSE for a long time, and we'd really like to see, particularly the SA stocks, I think, have a decent year. But it's been tough, but mainly, as I say, focused in the international listers.
Yeah, it's like markets are kind of in a wait and see game. Of course, we always try to find out what the prospects look like for SA Inc. At this point. Alex, does it look like there's going to be any light at the end of the tunnel for SA Inc. stocks anytime soon?
Well, certainly. I mean, if you do look historically, whenever interest rates pivot or start coming down, you start seeing a big move in equity markets. Now, we do anticipate at some stage this year that interest rates will come down in South Africa, and that will probably start a little bit of a re-rating in some of our businesses. We also do have, of course, elections. So our elections most likely going to be in the middle of May. So I probably would expect not much movement up until then, because only after the elections you would probably see foreigners and so forth to want to start buying back into SA, do so after so. And then, yeah, probably get some more insight as well, how the likes of load shedding progress over the year. Are we going to have improvement year on year? And of course, if these factors do come into play, I think there is quite a good probability that South Africa could have a decent year from an equity return perspective, because valuations are quite attractive. A lot of earnings is being depressed because of the weak economy as well as load shedding. So these things can perhaps reverse and surprise to the upside. But it's probably going to be some volatility before we start see evidence of that happening.
Yeah. Well, Alex, as you're talking about elections coming up, and of course there's this expectation that there's going to be more infrastructure spend ahead of the elections. And actually, I was talking to Chantal Marx on a Friday, and she was actually saying that Afrimat maybe should be one of the beneficiaries of that extra infrastructure spend. There's a question here. Ask the panel about the merits of an investment in Afrimat at present prices. Graeme.
Yeah, I mean, Afrimat to me is one of those companies that just sort of pivoted itself. Obviously, was in its history very much an aggregate business, moved more into mining and more acquisitions more recently. But yeah, I think given things like Lafarge, for example, that would position them very, very well. And I don't think it's just infrastructure. We're not talking just mega projects. I think there's really been a lack of building and construction in South Africa for a considerable period of time. We know, forget all the the big ticket exciting stuff. We actually just need to build stuff to replace what is broken, and to build the capacity for the enlarged population. So yeah, I think generally there are a handful of, let's call them building materials, construction type companies that I think could do very, very well on the back of even a small unleash in some of the spending that we've been promised for quite a long time.
Alex, I know that Afrimat has long been a favorite of the market, but I think it also did go through a period last year, if I'm not mistaken, where the stock was under pressure. What would you make of an investment in Afrimat at present prices, and maybe the pressure that they saw last year maybe was a buying opportunity?
Yeah, in our view, it certainly was a buying opportunity. So we do like Afrimat over a medium to long-term view, and that's based on pretty much their capital allocation record they've done historically. And we continue to back them going forward. So I think for the short term, what's happening in the Umthombo Afrimat mine is going to be important. Can they actually start delivering some cash flows there, which are promising? The iron ore is holding up reasonably well. And then the aggregates business is not doing too badly. And at the same time, we've got the Lafarge deal. We saw it's now being referred to competition tribunal. That'll probably be more of a medium to longer term story, but certainly that business has been undermanaged for at least a decade. So there's huge optionality for Afrimat. They can get their hands on it without assuming there's not too many punitive conditions tied to it. So we said they'll continue to back them. And we think there's exciting times ahead of the business. And also, obviously, projects in manganese as well, and others as well. So I think Afrimat is well positioned. It's not going to go up in a straight line. They will have the disappointment like any cyclical or any mining type of business. But we think the management is strong, and their strategy for us makes sense. The way they allocate the capital, the way they communicate, what they're trying to achieve. For us, they're certainly not trying to push the share price up for short-term gain. These are trying to invest for all stakeholders over the long term, which we like.
Yeah, all right. There's a question here on Sasol. Why is the Sasol share so volatile? Graeme, what have you picked up that this hinges on? Is it a whole mixed bag of things, or just oil and chemical prices at this point largely?
I think in large part it's chemical prices, but I think increasingly the market is getting its head around the fact that Sasol is a big CO2 emitter, and one day they're going to be fine with telephone numbers. So I think, if you just think of what the traditional Synfuels business must be spitting out, it looks, ridiculously, almost obscenely cheap. But against the backdrop of, businesses like this are really in the crosshairs of the environmentalists and regulators. And I think, you saw the fiasco that was the AGM. And I think just giving you an idea of how much pressure there is on businesses like this to transform. But how do you turn a fossil fuel business into a clean energy business? I think it's really tricky. So I think Sasol's underperforming for a variety of reasons, not least of which the oil price has come off. Of course, the rand's been a little bit weaker, but we've seen it at the pump. There's been a lot of relief, and that obviously would hurt Sasol. So, but I do think that ever since the Lake Charles debacle or fiasco, whatever you want to call it, management is under the microscope. There's I think a bit of distrust. Our view is that I don't actually want to own Sasol 5 years from now, but I think there are probably opportunities to make some money in between. And I would argue at about 160, 170 bucks, it really just looks too cheap. But it's a trading stock. I think now I don't think you don't want to put it into the bottom drawer portfolio because of some of those bigger issues and the environmental issues, as I said.
Yeah, interesting that your view is having Sasol as a trading stock. Second part of that question is, where's the price expected to bottom out? It's about 158 right now, quite cheap. Alex, do you think that it has reached the bottom, or it's too hard to call?
I mean, the bottom is always impossible to predict. I think the big difference between a Sasol and some of the other, call it the environmental stocks that's not particularly well received, that Sasol doesn't pay out dividends, right? So if you look at Tugela or any of the big oil players offshore, they're businesses that generate huge amount of cash and pay big dividends and do share buybacks. So you get a certain type of investor that will invest into that and say, "Oh, listen, I like this, I'm going to play." Sasol doesn't do that. It's a business that has got a lot of debt, got huge amount of capital it needs to spend to try to change the business. And on top of that, you've got assets which are aging, but poor management, and so just the combination is not great at Sasol. So I'm trying to find who is going to be the investor that's really going to buy this business, other than the trader that Graeme is referring to. And there's no doubt that Sasol potentially is offering quite a binary outcome. It's either it does this look too cheap at the moment, but we've been saying that for quite a while now. I mean, so Sasol could perhaps go back to 300 at some stage in the future, but can still half before it gets to 300 again. So we just don't know when the bottom would be, and if it ever will recover. Just because the use factors, balance sheet's not great, cash generation not good, and the management's not great either. And then the overall underlying macro fundamentals also not in its favor. So it is difficult. But certainly I can see you try to make a punt on a short term, but I agree with Graeme. I'll certainly will not be buying and holding Sasol for a 5-year period.
Yeah. All right. Well, let's go into property. There is a question on Fortress. What is the difference between Fortress A and B? I do also know that they still have that structure, but there was a vote on Friday in which they got shareholder support to simplify it. Not exactly sure when that will happen. Graeme, but maybe just a quick rundown of what the difference between the A and B shares was?
Well, generally what you have is in structures like this, that they weren't unique, although a lot of them have abolished them for a variety of reasons, often because, the underlying portfolios performed, but obviously before the COVID scenario. But effectively what the A and B structure does is it creates, let's say, an A unit that generally gets a fairly visible, fairly visible, slightly lower yield, but relatively predictable. And then generally your B units would be higher risk, where you take on more of the upside, but you take volatility in the returns. And then often what they would say is when certain conditions are prevalent, like when you get a certain level of income and effectively the returns are similar, there's often a structure then to convert and collapse them so that there is one. But effectively, A's and B's are generally there to provide for different types of risk return appetite, where B's would generally be higher risk. And I think, it makes sense to collapse them ultimately, although historically it did, in my mind, make quite a lot of sense, because you get certain property investors who are very bullish on portfolios. They want to take the upside, they want to take the gearing risk, etc., where you've got other investors who want greater predictability, and they know that if the earnings fall by 40%, they'll still get their yield.
Alex, now that Fortress is simplifying that structure, is this all good news?
Yeah, certainly. As I understand, they should be able to reroute and pay dividends quite soon. So that does create a good opportunity. Now, once again, our investors that specifically wants the A structure or B structure can then align themselves accordingly. Both stocks did quite well over the last year, up in the region of 50%. But for me at the moment, after this approval of this SOA, if you look at valuations, Fortress A looks quite interesting. It's both about 7% of its valuation is still the Nepi Rockcastle stake it owns. So that pretty much means the rump of Fortress A is quite cheap, and you are going to see dividends coming back and most likely going to grow from the space. So for me at the moment, A looks quite interesting without much risk. And obviously, as Graeme alluded to, if you do want a more geared exposure than B going forward, but certainly positive. And I think the drama we've seen over the last year is now out of the way, and now you can assess these two businesses back in its own merits again going forward.
Well, if I do understand it correctly, right, now that they're simplifying it, all the B shareholders will now own Nepi Rockcastle shares, right, Alex?
Well, they paid a portion of that, so it's not. I'll have to go get exact details up because I don't own the stock, so I don't know exact details. But certainly they use a portion of that A to pay off B.
Yeah.
But if you look what the numbers I looked at earlier, what A still holds of Nepi Rockcastle, still a big chunk of their market cap. So that tells you that the Fortress A rump valuation is still quite cheap.
All right.
But I can't quote you the exact details because it's something I invested in. I read that report earlier this week.
Yeah. Graeme, your thoughts on that simplification and also some of the shareholders getting the Nepi Rockcastle share, because there's also a question here asking about Nepi Rockcastle. Graeme?
Yeah, look, I think I must qualify this. I've been one of those property bears for quite a long time, listed property bears. So, in large part, we've got almost no, in fact, if you look at our fund, for example, we have no listed property exposure in spite of the fact that there's some benchmark there. But my sense is that Nepi is a pretty good asset. I do have a little bit of an anxiety that they are obviously Eastern Europe focused and mainly in retail. I'm one of the believers that e-commerce is going to disrupt traditional retail. So that's nagging at the back of my mind. But I think generally, I think that listed property companies, even when the gearing isn't out of control, it's going to be difficult. You've got rising costs through administered prices like rates and taxes, and unrecoverable electricity and water. I think a lot of tenants are battling, particularly in retail. So, my sense is, and the same is true, frankly, in other commercial like office. So, as a rule, we've avoided listed property like a plague. I know it was one of the better performing indices last year, but we're still not convinced. But out of them, I think something like Nepi Rockcastle actually looks quite good. And of course, for those who don't like SA exposure, Nepi gives you that as well.
Quite interesting that Graeme seems like he'd be going for Nepi. Alex, I know you said you don't own a Fortress, but if you were looking at any of those between Fortress and Nepi, which one would you be looking at more closely?
Well, the last few months I've actually highlighted a few property counters that I think is quite interesting. Because I think that they have probably troughed from a valuation perspective as well as operational. And those are, for example, like with the Pula and Bukele, even Grove Point a while ago, I highlighted. But I have to highlight between Nepi and Fortress. I probably have to lean towards Fortress because Nepi is such a high component of the market cap. So it means if you strip out Nepi, that means the rump or what the SA assets are of Fortress seems quite cheap. So, and to put it a different way, it's almost be buying Nepi at a discount by buying Fortress. So if you want to get that underlying exposure, for me at the moment, it makes more sense to do it for Fortress. But underlying Nepi, I think is still a reasonable good business. So I don't have any objections to owning Nepi directly as well.
All right. Before we move on, Graeme, you mentioned something about Afrimat. We were talking about Afrimat earlier on, and of course I mentioned that something that it could be a beneficiary of some of the infrastructure spend. Your additional thoughts there?
Yeah, I just wanted to make the point that, I'm always beating the drum about you, but just be quite clear what you're looking for. So if somebody's looking for SA unleashing, telephone numbers of infrastructure spend, then you want to be in purer construction, engineering, and supplies businesses, if that makes sense. And although, as Alex said, Afrimat's a very good business, it's quite diluted because of the other operations. So I would just go back to the viewers saying, if they were looking at Afrimat for GDFI or infrastructure spend, maybe there are other businesses like Wilson Bailey or one of the materials businesses that might actually be a better, purer play, if I could put it that way.
All right. Graeme, just sticking with you, Kibo, not a lot of stock that a lot of people look at, but maybe you might have some insight. I've been holding this Kibo share for a year. Currently, it is 1 cent, but my average price is 11 cents. Is it good to hold 2 more years or to buy more to reduce my average price?
Okay, so there are quite a few questions in one there. I don't know, Kibo, so I can't really comment on that.
Yeah.
The point is you're down 90%. You would have to, throw a hell of a lot of money to get your average price down. Besides, averaging down is for me, crazy logic. It just tells you might have made a mistake in the beginning. Throwing good money after bad fools is not always a sensible strategy. So if you really believe in it, then by all means do it. You don't, sometimes with all the will in the world and all the research and all the thinking, things don't work out. It happens to all of us. You've got a tax year end coming. You might find this person has made some nice gains on some financial stocks or, something else, or an international portfolio. Don't be ashamed to take your CGT losses in this year. So although if it's a fairly short-term holding, it's more of an income tax scenario. So no, I wouldn't say go and buy more simply to average your price down. The money that you put on the table before is mark to market down 90%. Nothing you do can change that. To throw more good money after it if you're not confident in the story, which this person probably knows more about the company than I would know more about the company than I do. If you're still convinced, then by all means, but don't try and reduce your in price. It doesn't change what you've already done.
Yeah, all right. There's a question here on Lewis, Alex. Any views regarding Lewis as a long-term hold?
We actually do like Lewis because they're buying back their shares quite aggressively and they give you back big dividends. So if you take the dividends and share buybacks, it's more than 20% of its market cap every year. And it's been, I think, over 17% over the last 5 years on average. So that pretty much means that you're getting 17-20% of your money back every year owning Lewis. Obviously, the capital appreciation hasn't been great, but we actually think that Lewis is relatively well positioned over the medium term. Because if you look at the advances book that they're actually building at the moment, it takes time for the book to reprice to the high interest rates. And that's going to start coming through now in the next, call it 12 to 24 months. You're going to see a big tick up in the earnings. And 2 years from now, most likely some of the bad debt issues we're seeing at the moment will probably also come down. But also at the same time, with the new IFRS provisioning, you're pretty much writing down, I think, 25 or 33% of your bad debt immediately from day one when the client signs, even though the client is still paying. So the cost is upfront. If it's not as bad as feared, then it can be written back into earnings going forward. So we actually think Lewis is not badly positioned on a 3 years old view. Longer term, longer than 5 years, I'll be some cautious because it is furniture retail and so forth. But certainly, if you take a 2 to 3 year view, I think the business is actually very well positioned now.
Graeme, do you think that Lewis is one of the steady eddies that we've got in terms of earnings, even though they do have, you know, that credit book and they're operating in such a tough environment, but they seem to kind of be resilient against it?
Yeah, I think I think it's a well-run business. The guys, play the cards the best they can, and it isn't a nice set of cards, the South African consumer, particularly in that space. But I think it's a well-run business, and what Alex is talking about, which is something a lot of investors forget. Companies can give you returns through good capital appreciation. They can give you dividends. They can buy back their shares at a good price and reduce the number of shares in issue. So when companies that have got sensible balance sheets and that are well run and where the leadership really has a feel for the business, when they buy back and return value like that, I'm a big fan of it. I think that segment of the market, and you saw it, for example, in a couple of the banks, the let's call it the more vulnerable section of the market, I think is going to be tougher for longer. But having said that, as Alex says, when you're making the provisions as you're required, it's not like you get massive shocks. So I think that they're good retailers. They manage a good retail book, but I think my sense is that environment is going to be unsupportive for a period. But yeah, I think Alex is right that maybe on a year or 2 year view it's worthwhile, but longer term, maybe there are better retail stories, maybe slightly less gearing, not gearing of a debtor's book.
All right. Well, let's get to your stock picks for today. Alex, what will it be?
So before the show, me and Graeme had a chat about SA looking quite cheap. And one of those, I think, is the banks for me. So I still like Absa. So the 2023 financial year is going to get the results soon. Slightly tough for them, but I think they can have a much better calendar year coming up. And if you look at the forward dividend yields, in more than 9% for Absa, and it's still growing. I mean, Absa is not anywhere close to peak earnings. So we think the business is still very well positioned. And whenever there's a bit of a risk on rally in South Africa or the sentiment improves towards Africa, the likes of Absa will probably re-rate back to a dividend of, call it 7% or so. So that pretty much means some quite decent capital upside while earnings and dividends are still growing. And we think it's a relatively low risk investment if you want to buy South African shares. And you can pretty much make that argument for most of African banks, but at the moment, my preference is for Absa.
All right. Graeme, on your side, what will your stock pick be?
A little bit embarrassing. Mine is also Absa, so it's,
oh, I love
it. Happy to go with another one.
Yeah.
But I think Alex and I think very, very, very much the same in some ways. So I think banks are sometimes like a window into the economy. ABSA, from a trading point of view, maybe a provisioning point of view, hit a little bit harder, and that just comes back to what we were talking about, Lewis, in terms of where they have their exposure. But I think Alex summarized it well. The only thing I would maybe add to that is, the year-end December forecasts of, we'll call it about $23 worth of earnings.
Yeah.
Even if you think that's a little bit lofty, and you say they'll do 22, which I would doubt. This business probably deserves through the cycles to trade on a 10 multiple, that gives you, call it 22, 23 times 10s, 222, 30 target price at 157-ish, that's over 40% upside. And I think, as Alex so eloquently said, you're being really well rewarded with a dividend yield that's beating cash. In fact, it's probably beating short-dated government bonds. So my sense is that as Alex said, your downside is quite limited. If interest returns to South African markets, I think ABSA could rate, and it has underperformed its peer group quite significantly. And, the reality is the tide goes out and the tide comes in. When the tide comes in, my sense is that all the boats will lift, but because they've been relatively marked down, there's more upside. So, but it's embarrassing. Sorry, we've got the same stock.
No, it's okay. I love it. Thank you so much for your time and for your analysis today, gents. Really, really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Alex Duys from Umthombo Wealth and Graeme Körner from Körner Perspective.